A very warm welcome to you as you join us on today's episode of Tax Matters. My name is Olumuyiwa Matuloko. Last episode, we spoke to you about the deadline for filing self-assessment returns and payment of company's income tax, especially for those whose accounting year is January to December. In this particular instance, if that is your accounting year, then by 31st of December 2016 was your accounting year end. And the Companies Income Tax Act gives you 6 months thereafter to file self-assessment returns and pay due taxes. And that is 30th of June. If you have not heeded that call, you have just a few more days. Depending on where you're watching this and what day of the week it is, you have just between 5 and 10 days to the end of June. And if you do fail to meet that deadline, then penalty and interest are due. And in that regard, we have news for you. The penalty remains 10% of the unpaid tax. That is 10% of the sum unpaid as tax will be added onto it. But as for interest, under that law, the minister has the power to add a spread to the CBN minimum rediscount rate, and the MRR for now is 14%. Now the minister has added 5% for those who have failed to file their self-assessment returns and pay due taxes on taxes due for accounting year January to December 2016. So by July 1st this year, interest will be 19%. So if your unpaid tax is 100 naira, there is 10% of that, makes it 110. Then there is 19% interest, makes it 129 naira. Quite a huge price to pay for not meeting deadline. And if you ask me, 6 months to prepare your accounts and file your returns and pay are just adequate. To give you more information as to what is required of you in filing self-assessment returns and payment of taxes, talking about company's income tax in general, we have a guest in the house. Mr. Adesina Adedayo is a chartered accountant and a chartered tax practitioner. In fact, a fellow of the CITN. Mr. Adedayo is a member of the council of the CITN and until very recently was the honorary treasurer of the institute. He is our guest today on Tax Matters, and the topic is company's income tax. Mr. Adesina, welcome to Tax Matters. So, we begin. What law or laws govern company's income taxation in Nigeria?
The primary law that governs companies' income tax in Nigeria is the Companies Income Tax Act, Cap C21, LFN 2004, as amended.
And what are the specific provisions regarding filing and payment?
When it comes to issues of filing, we need to first even look at the status of the company. If it is a newly incorporated company, it is meant to be within 18 months of its incorporation or 6 months after its accounting year end, whichever is earlier. If it's an existing company, we should be looking at 6 months after the year end in terms of filing.
Okay. So if I register a company newly, let's say I register a company on the 1st of April 2017, I will not be due to file returns until 18 months. Okay. If it's an existing company, 6 months after accounting year. Which one is accounting year?
The accounting year end is normally chosen by the company. And if you look at naturally in terms of cycles, we count in 12 months. And because we count in 12 months, it means you are at liberty to choose which of the 12 months you want to decide to be your accounting year end. You may decide to put the 12 months at June, July, any of the months in the year. And immediately that is chosen, you inform the tax office, this is the accounting year end I've chosen. And on the basis of that, it is now expected that you count 6 months after that year end and make sure your returns get to the tax office.
Okay. Companies income tax. What is the rate in Nigeria?
The current rate is 30%.
30% of
For
what?
30% of the taxable profit or total profit. There's another angle. You have the small companies rate, which is 20% for companies with turnover not exceeding 1 million naira.
20%.
Yeah.
But if my turnover is above 1 million, it's 30%.
Then you're already in the 30%
Okay.
category.
Which other taxes are companies expected to pay?
In terms of obligatory taxes, you still have issues of tertiary education tax. Then for some specific companies, they also have information technology tax or NITDA levy, which is 1% of profit before tax. Okay. Then there are also other areas where the companies has obligatory rules to play, such as value-added tax. So that is one area where they are expected to file return and show the difference between their output and input tax and remit accordingly. Then you have the withholding tax, which have dual functions there. In that case, there are some areas where the company renders services or goods in terms of a product. And when they have that, the person to whom they render that to has an obligation to withhold tax and remit on their behalf to the tax office. Then they also have an obligation to deduct withholding tax when it comes to their suppliers of goods and services and equally remit to the tax office.
So companies income tax, value-added tax, tertiary education tax, withholding tax.
Yeah, exactly.
What is the rate of tertiary education tax?
It is currently 2% of assessable profit.
You spoke about the rate of companies income tax being 30% of taxable profit. Now education tax is 2% of accessible profit.
Yes.
Which one is taxable profit? Which one is accessible profit?
Thank you very much. For you to actually arrive at accessible profit, you start from accounting profit. Accounting profit is normally determined on the basis of accounting principles and policies. And that is the one your auditor normally works on when he's working on your financial records. And in arriving at that, you have what is called accounting profit. On the basis of this accounting profit, you now decide the tax law operates on certain principles and procedures. Based on that, some issues are liable for audit purpose in terms of you are free to spend your money on yourself, you are free to spend your money on your children, you are free to spend your money on whatever you like. The accountant is not in the position to tell you, don't spend money the way you want. It will prepare his account on the basis of the records available. But when you now submit the record to the tax office, there is now meant to be a procedure for your tax consultant to work before he arrives at the various components of profit. Now, these various components of profit start from the accounting profit. Then you add back disallowed or disallowable expenses. Some expenses are not allowed for tax purpose. Then some income are exempted from tax. You take away those income. That is in respect of that. And then you now have maybe unrelieved losses. You may have losses that is already noticed or recognized by the tax office. On the basis of that, you take that away. You now arrive at what is called accessible profit. This is the first line of profit you now arrive at on tax for tax purpose. Now, for you to move from accessible profit to the level of taxable or total profit, you need to remove capital allowance. So capital allowance is taken from accessible profit, and then you arrive at your profit that is subjected to tax.
Which one is capital allowance?
Capital allowance is the alternative, or let me put it this way, is the government grant of allowance for you having incurred what is called qualifying capital expenditure in the course of you producing your profit or rendering your service. Now, qualifying capital expenditure is known in accounting terminology as non-current asset. This non-current asset suffers depreciation. Depreciation has to do with the estimated useful life. If you have a motor vehicle, for instance, and you assume you are going to use it for 4 years, using simple accounting principle, you divide the cost of the motor vehicle into 4. Every year you write off 1/4 of that cost. And then you call it depreciation. That is the accounting terminology. Now, because of the fact that the government can now allow itself to bear the whims and caprices of your policy, they come up with capital allowance. That irrespective of whether you want to use your car for 3 years, for 4 years, or for 5 years, that shouldn't be the problem of the government. You charge your depreciation on the basis of your policy. You get to the level of tax office, we now have to say, okay, what is the capital allowance rate for motor vehicle? That is a leveler. It means irrespective of your internal policy, the government apply the same rate to every company that comes forward. And because of that, your depreciation will be disallowed in arriving at your assessable profit, while capital allowance will be granted to you because the government recognizes you need those things in order to produce profit, and you now arrive at taxable profit.
What rate does the government use?
50% initial allowance, 25% annual allowance.
Okay. So what other examples do you have of what you call capital expenses? You mentioned vehicle.
You have plant and machinery.
Okay,
You have
like
furniture
our
and
manufacturing equipment.
Exactly, like the one you use there. You have equipment, you have furniture and fittings.
Okay.
All these attract capital allowances.
So when I buy them,
They attract depreciation.
when I buy them, if I buy a camera now, this April 2017, for 100,000 naira, they will consider that as expenses on something I use in generating income.
Sure.
Okay, and the government will now grant me 50% in the first year.
Yeah, exactly. No, it gives you 50% initial allowance and 25% again annual allowance. So which means technically in that first year, you get 50% of that cost instantly, and also additional 25% of what you have left. If you have to reduce it to figurative terms, at 100,000, for example, which is the illustration we are using, you have a situation where 50% of 100,000 gives us 50,000. You get that benefit immediately. Government recognizes the effort of doing business, the cost of doing business. And out of the 50% again that you have, you are also going to enjoy 25% also in that same first year, 25% of the 50,000 remaining in that same first year.
Section 55 of the Companies Income Tax Act, CITA Cap C21, Laws of the Federation of Nigeria 2004 and Self-Assessment Regulations 2011 makes it mandatory for all companies to file their annual companies income tax returns with the Federal Inland Revenue Service FIRS within 6 months of their financial year. All companies with financial year end of 31st December 2016 must therefore file their tax returns not later than the 30th of June 2017. Principal officers, especially chairmen, managing directors, executive and non-executive directors, and chief financial officers of companies, including those exempted from incorporation and those not liable to pay tax, are thus reminded that they are required to file their self-assessment returns before the close of business on the 30th of June 2017. The country's tax regulations demand full compliance. Failure to comply will attract penalties in accordance with the provisions of relevant tax laws. Tax returns can also be filed online at www.efiling.firs.gov.ng. It pays to pay your tax. This message is from the Federal Inland Revenue Service.
Yes, indeed, it pays to pay your tax. Welcome back. The program is Tax Matters, and our guest on the episode today is Mr. Adesina Adedayo, a chartered accountant, a chartered tax practitioner. Mr. Adedayo, welcome once again.
Thank you.
Before we went on break, you spoke at the beginning about the obligation of companies to file and pay companies income tax. And you did say that for a newly registered company, it has 18 months from the date of incorporation or 6 months after accounting year end to file companies income tax returns. For a going concern, for an existing company, 6 months after accounting year. But we know for a fact that value tax filing and payment, that is remittance of VAT collected on behalf of government, is filed every month. For that newly registered company, does it have those 18 months to begin to fulfill that obligation under the VAT Act?
No. For the VAT Act, you will agree with me that, one, there is an element of collection on behalf of government. Because in the course of having your input and output, you've commenced business. A company has commenced business. It has 18 months within which to say, I'm filing my returns in terms of my business performance. But when it comes to value-added tax, the company is now in a position, for example, it has paid VAT, which is an input. And it has also collected VAT, which is the output. Now, naturally, it has 21 days after the end of the month in which this transaction happens, within which to file. Because you now need to render account. You've just had money belonging to government in your possession, and naturally you should do that on monthly basis. That is why the VAT rule is different from the Companies Income Tax Act.
What is the implication? I registered my company 1st of April 2017. Are you saying that I should immediately become known to the tax authority?
Yes. In fact, the natural thing I would have even expected is that at the point of incorporation, you should even have been known to the tax authority.
They do that now. The FRS is in league with the Corporate Affairs Commission.
Once at the point of incorporation, you're already known to the tax authority. And you had a mind, you had a vision before you incorporate a company. Whether you are starting immediately or later, or maybe you are putting some things together, the knowledge of your existence by the tax office, first and foremost, create an educational platform where you can be guided. Two, it creates a platform for you to have an idea of your obligation, because ignorance of the law is not an excuse. If you're already aware that you need to file your VAT returns, if you don't do business, file a nil return.
That's allowed.
Exactly. Nobody is forcing you to say you have to pay, but you need to be upright and have integrity relating to that. I can incorporate in April. I may not start till December. So naturally, what is now expected of me is that once I've incorporated, by April, I file the return in May to say, look, nothing has happened. I'm still thinking. I'm still coming up with my vision and mission statement. All these things are allowed, but you cannot keep the taxman in the dark when he does not know what is happening. If you are peeling a groundnut for a blind man, you need to keep on whistling. That's the only way the blind man will know you are not eating part of the groundnut. And that is very important.
I have to continue to whistle.
You have to whistle. Otherwise, the blind man, you can swallow it.
I like that.
So, and the taxman is a blind man here. Information given to the taxman will help them know your status, whether you are yet to commence business or you have commenced business. And when you commence business, you have an obligation.
Am I not exposing myself unduly? They will start coming to trouble me.
Naturally, we should not see tax administrators as people who come to trouble you. And I think I like the leadership of the Federal Inland Revenue Service as of today. Tax is supposed to be something that, one, educating people on tax, even people who are literate, is a challenging thing. And when you see the taxman from the perspective of guidance, from the perspective of letting you know what you need to do, it is equally part of improving your corporate governance. A challenge of tax can embarrass you if you have a situation of non-compliance, for example, pasted on your office. It makes responsible clients to think twice about doing business with you, because it labels you as somebody who has integrity challenges. So naturally, what does it cost you to fill a form and take it to the tax office and submit and say, I'm here to do anything? It is just the truth. If they decide they want to know and you are not hiding anything from them, then you can open the books to them. They may even guide you. This is the way you should keep this record so that you won't have problem with us tomorrow. I see it more from an educational perspective.
I agree with you. Let's go a bit practical. I decide with some business partners or on my own to start an hotel from the scratch. I have a name in mind, but I go and buy a virgin piece of land I want to build. Now, what do I do I first of all go and register the Corporate Affairs Commission.
Sure.
Then what do I do?
Immediately you register with the Corporate Affairs Commission and you have determined your line of business. The natural thing to do, the responsible thing to do is to also go to the tax office and have a tax identification.
My hotel has not started though.
Yes, you have a tax identification number. Now, let's look at it administratively. What does it cost us to write a 2-paragraph letter to the tax office? I said, look, this hotel is still at conceptual stage. We are yet to start. We are still putting a lot of things together. I mean, you have, and then people don't operate in oblivion. You have a situation where we operate in a society. By the time your hotel is even about to open, maybe it is going to be in the newspaper. So the taxman is not as if the taxman is hiding somewhere and unaware of what is happening in the social terrain. So it is something that has to be cross-checked, what you have informed them and what you are actually doing. If you say your hotel is not about to start and maybe a tax official check into the hotel, took out a 2 or 3 days accommodation there and paid you, how do you justify your administrative letter written to them and the action that is there? There are so many ways that integrity can be checked and verified. So naturally, the best thing is to be on the right side of the taxman. Because when you're on the wrong side of the taxman, a lot of evidence can be gathered to show that you are being economical with the truth.
So if it takes us 3 years to build that hotel, what happens to that 18-month rule? What happens to the 1-month VAT rule? What will my dealings be with the tax authorities from that day one?
Let's look at the issue of transparency and disclosure. If you have not done any form of business and all you are doing is incurring costs, it's also very straightforward. You keep filing your VAT returns and saying no business for now. That means you have not done anything. So nobody is going to ask you to pay VAT that you have not collected. One. Now, when it comes to the 18-month rule, what do you need to do? A statement of affairs to show that this is the cost I've incurred to date and I'm still incurring. And then you file it with the tax office and then they have it on record. They put you under this thing, under the new case file, because as far as the tax office is concerned, you are still a new client coming up looking at ultimately generating future income. So they put you to more or less like on a watch list and say, okay, let's keep seeing. Eventually, they will get to a stage where they will at least open. It may take you 3 years, it may take you 4 years. Nothing is going to be rushed about it, but information needs to be at the disposal of the tax office for them to know your status. Even if you are discontinuing the business, you will still need to inform them that I'm no longer interested in this business, I've just changed my mind.
Cessation.
Exactly. If you are even changing the nature of the business, you may decide you want to build a hotel and along the line decide that no, hotel does not seem to favor me. I want to change it into manufacturing. You still need to inform the tax office. Because first and foremost, the reliefs and allowances for manufacturing is radically different from that of hotel. So when you change your mind in terms of even the business you want to engage in, you need to also inform them.
Okay. Has any of your clients experienced where the taxman will just say, pay something, you know? They're always under pressure to raise money for government.
Yes.
I'm still building the hotel. Okay, we know, yeah, but pay something. Does that happen?
It has happened, and I think we were able to deal with it. Because you see, I mean, the perception that some officials have is, look, you need to at least show that you are paying something. That is technically wrong. Apart from pre-operation levy, which you are supposed to do in the first year in which you approach the taxman for your tax clearance certificate.
Which one is what one again?
Pre-operation levy is right there in the law. You see, naturally, you cannot have any tax that is not backed by law. And when you have not yet commenced operation, that is why it is called a pre-operation. When you have not yet commenced operation, the taxman says, anytime you come forward, it means you want to use the tax clearance certificate for something. And you want to use the tax clearance certificate in order to legitimize the pay something rule.
Pay something?
Yes. So the pay something rule in this case will now be a levy under pre-operation levy. And it is bad. It is 20,000 in the first
Oh,
year.
I'll pay that one in the first year.
Yeah, we should come forward for tax clearance.
The Federal Inland Revenue Service FIRS calls on all corporate organizations operating in Nigeria to register for the purpose of payment of taxes and obtain a tax identification number TIN. All registered companies must obtain a tax identification number immediately from the nearest FIRS office. You can also collect and return tax registration forms from the Federal Inland Revenue Service Engagement and Enlightenment Tax Teams, FEAT, on compliance checks exercise in your area. A company which is yet to commence business after at least 6 months of incorporation must pay a pre-operational levy of 20,000 naira in the first year and 25,000 naira for subsequent years to obtain its tax clearance certificate TCC. Note that filing and payment of VAT and withholding tax returns must be done on or before the 21st day of every month. Register for VAT. File all tax returns as and at when due. Be a responsible corporate citizen of Nigeria. It pays to pay your tax. This message is from the Federal Inland Revenue Service.
Because of time constraints, we have to continue this next episode. On this same station, same day of the week, same time of the day. We'll see you around.